You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mike Yahoo. Hey, what's up, Market Moose? Mike's on The Moose on the Loose. Happy Monday. Personally, Monday is not my favorite day of the week. I'm like Garfield, but actually today I'm quite excited. Quite excited because last week we had all the big banks, Canadian banks, reporting their earnings. And like some quarters, it's kind of boring where it's just like business as usual, like revenue, dividend increases, this and that. But there's not much to tell that much. But this time we had like a very interesting quarter. I will do a full review this Thursday on my YouTube channel, but I wanted to talk about like 4 big stories that I've seen in this quarter. So if you want to go for the full length video, that's going to be on Thursday, but today you're going to get a small preview actually on this. So the first story is CIBC. CIBC is back from the dead in the sense that I've seen this one as like I love to like rank the banks from like 1 to 6. National Bank and Royal Bank are always my top 2, and Scotiabank and CIBC always bottom 6. Like it's been 15 years I'm doing that. It's been 15 years. Like those are pretty much the both extremes. But right now, CIBC is getting better and better. So they had a very bad year. I think it was in 23. 24 was getting a lot better. And then in 25, it continues. So what happened back then is they made acquisitions to expand their business in the U.S., classic play for most banks, actually. And it didn't go as well as planned at the beginning, meaning that they had to increase their provision for credit losses a lot. And that hurt their earnings. I think it was in 23. So the stock price did not do well that year. It definitely lagged other banks. And now it's like recovering from those PCLs, and the rest of the business is actually pretty solid. So the last quarter, personal and commercial banking in Canada was up 4%. The U.S. business was up 15%. Wealth management 13%, and capital market up 20%. So all double-digit growths besides personal and commercial. So that was a very solid quarter for CIBC. So I was kind of surprised, and I wanted to highlight it. I've been bashing CIBC for so long. I mean, it's just normal that for once in a while they are doing something right. Well, let's spread the good news, right? The second thing is acquisitions are paying off. So after the CIBC story, there is also an ongoing, actually, there are more than one stories actually about acquisitions these days. So we add Royal Bank that bought HSBC assets, and now it's reflecting on their quarters in 25. It's been like a couple of quarters actually that those numbers are being integrated, but that creates a solid boost actually. So the earnings per share for Royal Bank was up 7% this quarter, mostly driven by HSBC. So that was pretty solid. The other bank that made a significant acquisition was, of course, National Bank, that completed and is integrating Canadian Western Bank right now. Cost a little bit more than $6 billion. So the offer at first was about 5. There was it was paid by National Bank shares. National Bank shares like skyrocketed. So in the end, it was a little bit more costly for them. But that is already growing their earnings per share. They had a pretty good quarter for National Bank, up 12% for the EPS. There was some dividend increase as well, but I'm going to cover that. All the dividend increase and everything will be covered on Thursday. So you don't want to miss that YouTube video for sure. One thing that was quite interesting is while the personal commercial and the U.S. international business was up like 2 and 4%, so that was not that much. Double-digit growth for wealth management, and crazy like jump for capital markets, up 56%. Of course, that's not necessarily related to Canadian Western Bank. On the other side, it's kind of like tricky because Canadian Western Bank added a lot of provisions for credit losses on the personal commercial side for National Bank. So that's the reason why it's only up 2%. So see how sometimes, and I think for the long run, it's going to be an amazing acquisition. But for the short term acquisitions, I mean, there are a lot of integration costs, and then sometimes you have like some small surprises like this. I'm pretty sure that National Bank expected that, but we're talking about like more than $200 million in provision for credit losses. So of course, that kind of hurt a little bit National Bank's earnings for this quarter, but nonetheless, they made a great quarter. Another story that is quite interesting is TD Bank. TD Bank is like coming back from the dead after a terrible year, after the money laundering lawsuit and the fine, and having regulators on their back and having like a cap on their US assets. Well, the stock price is up like 26%, including the dividends since the beginning of the year. I mean, all the other banks are like either up like 3, 4, 5, 6, 7%. This one like 26, like beating everyone. It's like, whoa, we're making a comeback on track. They sold their assets of Charles Schwab's. That was announced, I think, the last quarter. Now they got the big check to show. So big jump on everything there. That's going to give them, well, it was a good move in terms of like making a good profit by selling a high quality asset, but it's also going to give them plenty of cash to restructure their U.S. activities. So what they're doing here is, since they cannot grow, they kind of like grow internally. So they sell assets and they're trying to buy other assets instead to still have a way to maybe make it more profitable, or buying undervalued asset at this point. So eventually it's going to grow and it's going to be worth more. So TD's trying to come back at this point, and it's working well for them. Like, and of course, wealth management has been a big support. It was like the name of the game for all banks. So yeah, so TD's kind of back here. I thought TD would have been a good kind of like deluxe bond for a few years before it can come back, but it seems that it's coming back faster than I expected. So good for all TD shareholders, right? So that's great news. Finally, the fourth story. So the first one was CIBC. The second one was the acquisition that are paying off, but sometimes tricky. The third one was TD getting back on track. The fourth stories from this quarter: diversification wins all the time. In the video that I will publish on Thursday, I will also talk about EQ Bank, about Go Easy, and also Propel Holdings. So a small cap fintech, super exciting. So I'm gonna talk about those three on top of the big six. And one thing that I can tell you up front, spoiler alert, the banks that are well diversified with not just savings and loans and commercial activities, but with wealth management, with capital markets, with expansion internationally or on the US, with insurance products, well, they make a lot better. They make a lot more money. The best segment overall for all the big six was wealth management, and most banks also benefited from strong performance from capital markets. So when you're EQB or Go Easy, you don't have those tools, those growth vectors to compensate when the business is slowing down or the economy is slowing down. Because I mean, when you do savings and loans, if there is a recession, if the consumers have a hard time paying their debts, well, there you go. You're limited to grow, and if you're giving out more loans, chances are those loans will not be as strong as the one that you underwrite a year or 2 years ago. So there's always that balance that you have to fight back. So that's something super interesting to consider. So always keep that in mind. They are small, they move fast, they are exciting, but they highly depend on the economy. While the big banks, they're boring, they're dinosaurs, but they always find a way to make more money. Anyways, so all right, Moose, I hope that you have enjoyed this short recap. Do not forget that to follow me on YouTube to not miss the next video next Thursday about the Canadian Bank's earnings review plus the small banks. And tomorrow we're going to talk again on other topics. So until then, don't forget to stay invested. Hey, welcome to the disclaimer. If you're listening to the Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy the show and do your due diligence after it.